It's Brian Preston, the Money Guy.
The Security Act explained. Because I wanted to jump in and answer the big question first, but now we need to talk about what you need to know. And I thought there was no better way to do this than if we just broke down what's the positives of this legislation, what's the negatives, and all the things that you kind of need to know about this.
Yeah, I thought it was interesting, because we like a lot of symmetry. What I found was interesting as we kind of talking through show prep, in my opinion, my humble opinion, it didn't seem very symmetrical, the positives column versus the negatives column.
It is true because, look, I tried to really turn this pile of lemons into lemonade because here's the reality of the situation. Don't base it off of how many words we put on each column. The positives are pretty slim on this. I mean, it just is. I'm going to show you where the spoonful of sugar is. Don't make me sing it again because I'm a much better CPA financial planner. I know you were trying to do it. So let's talk about the positive first. The short list of positives is go ahead and kick it up.
Yeah, the very first thing is that the required minimum distribution age for your personal IRAs has increased. Used to, in the year that you attain the age of 70 and a half, you would have to start pulling money out of IRAs, 401ks, 403bs. That number now has changed. That age has now changed to 72. So you get an additional year and a half.
So everybody, there's going to be a few people out there that say, well, I started taking minimum distributions last year. I turned 70 and a half in 2019. Well, does this mean I get a free year off? I get to hit pause on taking the distributions? I see your face.
Unfortunately,
the answer is
no, it does not.
No, you're going to have to. Unfortunately, you're grandfathered in. You started last year. You have to stay on that RMD train, required minimum distribution from now on. But if you're a person, so I guess that everybody, this really doesn't impact a lot of people until we start having some new 72-year-olds in the coming future.
The second big positive that we saw from this is now the IRA contribution age limit has been removed. Previously, if you were over age 70, you couldn't contribute to IRAs anymore. Now that has gone away. So if you are advanced in age, advanced in years, and you want to still be saving to an IRA, you can now do that.
Age discrimination has been taken away from IRA contributions and retirement contributions. That's a good thing. That means anybody can contribute to these things. They don't cap you. So I think that's a positive. And then this is what Bo was talking about, because we're going to have a whole list of negatives, and he's going to make fun because we're now about to switch over to a screen that shows you other notable benefits that came from this legislation. It seems like this is great, but this is the spoonful of sugar because remember, this is a tax grab ultimately. But let's rapid fire fashion go through the other things that were put into this legislation. The first was there's going to be a $5,000 penalty-free distribution for qualified births and adoptions.
So if you're someone who's trying to grow your family through adoption or something like that, there's now a mechanism where you can use the proceeds for that purpose.
Adoption or having a baby, it doesn't matter. You get $5,000 penalty-free. By the way, this is not tax-free. This is just penalty-free.
That's right.
I still don't know that I love people hitting their retirement accounts for these type of life expenses, but now if you got in a pinch, you at least have access without penalty.
Yep.
There's also tax credits. I thought this was great. This is some sweeteners. And by the way, this is not the part of the Secure Act. This is kind of some other sweeteners that were in the legislation. But there's now a small business establishing a retirement plan. When I say small business, I'm talking about you have less than 100 employees. You get a credit. If you start a new retirement plan and you have a bunch of employees, you can do $250 per employee up to a maximum credit of $5,000. If you're it's just you as the employer and you're the only person on the payroll, then you'll get a $500 credit on your taxes.
There's even some other tax benefits for businesses where if you have some sort of like automatic contribution system set up for your plan, there's even a tax credit available for that.
Auto enroll. You get $500 for that. It's like the government was like, here, take you $500. You get $500. You get $500. So that's cool. And it doesn't have to be a brand new retirement plan. If you add the auto enroll feature to your old plan, you will also get a $500 credit.
That's a great point. If you're someone who is in HR or you own a business and you want to add in automatic contribution arrangement, might be able to get some tax benefits for the business.
The next benefit, this is one that's going to take a while. It's going to take the season. You got to kind of put it out. It's got slow and low. I like to smoke brisket. You're going to want to the multiple employer retirement plan is going to probably be something to look into in the next few years because I think some creative people are going to realize economy is of scales. Let's go put a bunch of people, like maybe your trade organization or something. You can all come together and go start a combined retirement plan. Why this has not happened? Because this has actually been around, but nobody's actually done it because there was an IRS provision that was called the one bad apple. And I mean, if there was another financial planner across the street I don't want to vouch for how good they are at, setting up a retirement plan. If they did something wrong with the way they process payroll, so that one bad apple ruined it for everybody because nobody wanted to be held accountable, and it could ruin the whole plan if you had one bad guy. That's kind of been lessened right now. And then what I like about this, it really does take advantage of when I say economies of scale. Just like you can buy peanut butter a lot cheaper at Costco and Sam's. If you can combine a bunch of employers together, they might qualify for the same type of plans that you see at Fortune 500 plans. So that's a good thing. I want to go through the rest of these. Taxable non-tuition fellowship stipend payments are now treated as compensation. So if you're one of those people getting your doctorate or something like that and you hated that you couldn't go contribute to an IRA, that's been fixed for you. So start saving away. Also, there's some foster care payments. Difficulty of care, which is non-taxable. A lot of foster parents couldn't count that portion because it wasn't taxable toward their contribution eligibility. Now that's open for you. There's also, I didn't even know this existed. There's some innovative person, mastermind, I'll just use the word, figured out that they could go set up almost credit cards for setting up a credit card that's attached to your 401k so you could do revolving loans.
That sounds like the absolute worst idea ever invented.
Well, the government thinks so too. So they have gone ahead and put a stop to that. I know there's not a single 401k that we do any work on that we would think that that's a positive thing. So I don't know how that. There are a lot of people helping you try to part with your hard-earned dollars. And then, man, 529s, I think there must be somebody up there in Washington, D.C. that gets them really excited about 529s because they keep expanding benefits. You guys, $10,000 for one-time qualified education expense to repay student loan debt for you, siblings. I mean, there's all kind of features there. It's one-time $10,000. So it's not like you could come back if you had $40,000 of debt and do this over 4 years. It's a one lifetime $10,000. Also, you can now use your 529s for apprenticeships. That's for, what I thought was interesting, it even covered equipment.
Oh,
so
really?
that's kind of cool. Yeah. So all kind of things with apprenticeships can now be part of your 529.
So what I think when I hear all that, I think I thought there were two big positives, and then there was some other just stuff. I don't want to.
That's a spoonful of sugar.
So 70.5 now has gone to 72. You can still contribute to an IRA, and there's these other notable changes that we just went through. Now let's start talking about some of the negatives, some of the downsides of the Secure Act.
Well, definitely, we've already talked about the stretch is greatly reduced. I mean, it is limping around, and the new rules and beneficiaries inheriting your retirement accounts basically have 10 years to unload this thing. You get to choose it. They're going to give you flexibility on when you take that distribution, but you have to have it cleaned out by the 10th year.
Now, the one thing that you need to know is there are some exceptions that we'll talk about for eligible designated beneficiaries. So it's not the stretch IRA is not dead. It's not gone. It's not removed, but it is limited now.
Yeah, it's got an asterisk now for spouses, disabled or chronically ill, those who are not more than 10 years younger than the person passing away, and then certain minor children. Now, I thought it was interesting. If you have a minor child, if they inherit as soon as, say, the state, majority age is 21.
Sure.
They're just going to go off their life expectancy until they hit age 21, and then the 10-year clock kicks in. So they actually get to defer it until they're 31. So it's kind of an interesting thing about the rules. And this I want to talk about why the stretch. This is a bad deal. Is a lot of people don't realize, we showed you previously in the show the numbers, but think about this. A 55-year-old would only have to pull about 3.4% a year. Okay. Even a 65-year-old would only, their RMD on that would be about 4.8% of the total value of the account. Now you have to take this over 10 years.
It's a much larger percentage of the portfolio.
It's accelerating this tremendously. I think it's worth an echo. If you turn 70 and a half in 2019, you're still stuck taking required minimum distributions. Here's another area of concern I want to watch. Just like I was talking about, the multiple retirement plan option could be a future benefit. Here's something I think could be a negative. And I worry about this because I know it was lobbied for hard. So I'm curious to see what happens. We've all heard about this fiduciary standard is so important in retirement. That was the big thing that came out of the fiduciary rule. At least retirement accounts kept it.
Where you held
to a fiduciary standard where it scared people. You knew that you need to be very careful with what you put into a retirement plan because it was held to the fiduciary standard. Well, now this legislation added what's a fiduciary safe harbor. Wait a
Hold on,
minute.
but if you're fiduciary, why do you need a safe harbor? That doesn't make any sense.
So safe harbor means this is going to give you some shelters from some of the legalistic requirements of fiduciary. So now this is going to allow a lot more annuity type options. And I pulled this right. Here's the quote. No requirement to select lowest cost. Nothing in this subsection shall be construed to require a fiduciary to select the lowest cost contract. A fiduciary may consider the value of a contract, including features and benefits of the contract, and attributes of the insurer, including without limitations, the insurer's financial strength in conjunction with the cost of the contract. So this thing's going to open it up. We're going to see a lot more annuities come back into retirement products. I'm sure that was lobbied hard in Washington because we know how the whole system works. And then this is just a little filler negative is increased employer penalties for failing to file employee benefit plan returns. So they're just those informational returns, you better get them in because they're increasing the penalties on that.